Hello, everyone. My name is William Mucker. I am a client executive with Camplan, and would like to thank you all for joining us for today's webinar, Navigating Gold's Role in a Shifting Global Economy, Insights from 2024 and Forecasts for 2025 with Brandon Green, Director of Sales with Neptune Global. As a quick note, please be aware that we will be answering questions at the end of the presentation. However, feel free to use the chat or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camplan, nor do we endorse any products. We will never call you about the next best investment opportunity, and we believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I'd be more than happy to help. And without further ado, I'll pass the controls over to you, Brandon.
Thank you, Will. All right, that was a good introduction. Thanks everybody for taking the time on this Thursday at noon Eastern. I'm looking forward to bringing you some useful information from last year and this year, and hopefully it can help you make some more informed decisions. Only going to be approximately 15 to 20 minutes, nothing more than that. And we should get going. So I am going to share my screen, I believe, Will, right? Let's see here.
Yes, sir.
How are we doing?
Looks good.
Does that look good?
Yep. Perfect.
All right. Okay. So topic was, gold's exceptional year and the future of it, right? Some key insights, some strategies for this year. Gold had a great, all metals had a good year last year. And we expect that to continue. So let's take a look at some key points and key value props about what happened last year. Well, gold achieved 40 all-time highs, daily all-time highs. And just to put that in perspective, it's only made about 300 daily all-time highs in the past 20 years, which is still an achievement. But it made quite a significant last year, which means it had a nice, small uptick, not volatile spikes up and down, had a nice smooth run, making these all-time highs throughout the year. And what was that? It was 27.86 back on October 30th. We are getting back there already. It did pull back from then, but all the analysts, including ourselves, are projecting that to be blown through very, very soon. And we'll see it probably the next few weeks. Now, year-over-year growth was 25.5%. That beat all other major asset classes. It outperformed the S&P. It definitely outperformed all other commodities and definitely the bond market. So it had a phenomenal year. It could still do it again, but as stated, it did outperform all major asset classes, and it did its job. We had quite a few issues happening and supply-demand issues. So let's see what some of those key drivers were. One, central banks. They bought 959 tons in the first 3 quarters. We don't have the last quarter yet. That should be out in the next couple of weeks. But in 2023, they bought 1,037. So just in the first 3 quarters, we almost bought the entire amount of 2023. I'm suspecting, close to 1,200 tons. But that's a key driver. These central banks are smart. They buy and they know what they're doing. So that's a key driver to gold right now, which is something to keep in mind. Heightened geopolitical risks really, really drove gold and other metals. It had the market volatility. It boosted its safe haven. And, we've had a few things happen, I guess a ceasefire, but some other things are at play. China and South Asia and other things like that. So keep an eye out on those, but the geopolitical risks did really make part in gold's increase. We also had some lower yields, especially in the beginning of the year, and weaker US dollar, which really boosted the investment flows. We did see yields come up a little bit too quick, and there's a few of us have been talking about that, and we will talk about that in a little bit. But that's really what drove gold in 2024. What about in a global sense? Well, I'm going to go back to central banks. They contributed with 7 to 10% of the growth. It's estimated that their purchasing was about 7 to 10% of that. They are been consistent net buyers for the past 15 years. Net buyers. They have made no indication of stopping, only indications to keep buying, and there's no reason to not think that that won't happen for the remainder of at least of 2025. For the point of this presentation and the topic, there's been no indication, so expect them to continue buying right at this moment for the first quarter. Also, China, India did really come into play. India reduced some duties on imports, which helped gold, and also China was pushing investment demand. So this is some of the key factors that really pushed the prices in 2024. So final take on that, we had some favorable market conditions. There was a little consumer demand offset by institutional, but the key geopolitical events influenced gold prices. It's a critical role in a hedge and a diversifier in these volatile economic times. Now, what's happening in 2025? So about the end of November, analysts put out their price predictions. Goldman Sachs, JP Morgan, Credit Suisse, they all put out their price prediction. We had a range bound. We had a range of 2,700 to 3,100. Now this was in November. I know we're above 2,700 now, a little bit above 2,700, but this was back in November, beginning December. So they were doing their range was actually the low end was where gold was. It was actually even a little bit lower at that time. So sometimes you'll see them do ranges of $100 less, but they are looking at a $400 range to break 3,000. I think that's very easy for this year. So, and 3,100 is going to be a key point later in the slides. Okay. So what are we going to see? Well, when we see some monetary policy shifts and Fed's likely to cut 100 basis points, there's still consensus that will happen again, especially with the markets and the rising yields lately. You'll see the European central banks also follow, which would be favorable for gold this year. So keep an ear out for that, and we'll see when that happens. By year end is when they're saying for the 100 basis points, but we'll see. We'll see. So key factors to watch in 2025. No matter the administration, whatever they want to do, but if it's in any country, in whatever political spectrum, we do have subpar global economic growth. The current American administration, though, is really, it's all about growth. So if that happens, that's inflationary. So we need to understand that, yes, growth is good, but it's also inflationary. So if that's a big push, keep that in mind, because that could be money pumping. I mean, yes, there's talk of cuts, but there could be it could be a very, very inflationary aspect. But growth is good. Speaking of inflation, we've been above target levels for a long time. Yes, we did have a Inflation Reduction Act. Arguably, it did its job, or it didn't do its job. There was a lot of inflation still, all above target levels. This is a very difficult aspect of managing the economy, and precious metals can support even that. So this is something to look out for. Hopefully it doesn't get out of control, but if it does, you need to be protected for that. Right now in Europe, there's quite a bit of instability, especially with the banking and the debt. Just I think a few days ago, Ray Dalio of Bridgewater, very, very respected investor, said the UK could be heading for a death spiral. I mean, we're not immune in any country. So when things like that happen over there, you think it can spill over, can happen. You know, everybody's co-invested in different things. Also, the ECB put out that they're concerned about France again. They're concerned about, I think Germany was in there, and also Greece, which we all know had a crisis a decade ago. So that's definitely something to look out for. And if you know that's happening, you can protect yourself. And central banks, we got to see what they're going to buy this year. I think it's going to be more. So it's a key factor to watch about what's happening. It's going to, they are going to support gold prices. So takeaway on 2025, okay, is we're going to see some upside potential because we still have deterioration in financial conditions. There's going to be a lot of pain before it gets better. I think that's going to be something that's really a big takeaway, especially in the next 4 years, or maybe in the next 1 to 2 years. Pain before it gets better. So something to keep in mind. We're going to see higher than expected central bank purchases of gold. Debt. We're going to talk about debt in a second, but that continued debt creation is going to continue. It affects gold. There's a very high correlation. We're going to talk about that. I have to be fair. Any downside risks in the markets? Well, rising interest rates can hurt gold prices a little bit. It can happen, and but that's if it's going against inflation, we might see it might not matter. And declining consumer demand. If they're raising interest rates because of inflation, well, gold is going to do well in silver. But if it's just rising interest rates due to the market, you can see it pull back. And if consumer demand comes down, but institutional is very strong. So I wanted to take a minute in this presentation to talk to you guys about the anatomy of a financial crisis and why they happen and why you need to be protected. Because you don't really see them. They come from no risk assets, right? Like government bonds, long-term, short-term, they're supposed to be no risk assets. But when you have overconfidence in them, especially when banks buy a lot of them, it can destabilize the financial system. They can have a lot of these on, this is what happened in 2008. They can have a lot of these on their books, right? And they buy these at par value, and rising interest rates bring down the value. So if they need to sell these, they are at losses. And these losses are not losses that we are all familiar with. They can be big. And this is why injections need to happen. So one warning sign is high rising bond yields. And that's something that's been happening in the past 6 months. So there's been a few people talking about that. They've been saying that this is a concern. So what's going to happen? Well, we can see declining currency values and inflation really happen. So you need to look out for these bonds and these government bonds, because that's where these people that call financial crisis, that's where they're looking. They're not looking at some of the stuff that some of us on the lower part of the totem pole are looking at. So keep these in mind, but this can happen and you need to protect yourself, right? The triggers. So the key drivers of at least metals in crises are debt, right? So you need to understand that right now we're in unfunded liabilities of 600%. France, Germany, unfunded liabilities of 350% of GDP. This debt has its limits. It causes economic, fiscal, inflationary constraints with governments. Eventually, the pumping of money may need to happen. Buying back of debt. Restructuring debt. There's only so much you can do, and everybody needs to be careful. It's a really tight rope, crazy tight rope for that. So I want to talk about the US debt and why it's important for gold in the coming years. So here is a chart of the US debt, right? The total public debt, Department of Treasury. It starts at around, I think it's around 8 billion. No, 7 billion. It's like 37 trillion now. Well, let's take a look at what happens with gold together with the debt. Here's how they dance, right? Gold and debt have been rising pretty steadily since about 2002. Now, this chart isn't like each of one of these to scale and the actual percentage of returns. It's just so it fits nicely in there. But I'm going to show you how gold actually has outperformed it, but it's a key factor in it. So public debt, gold price, very highly correlated. Well, what's happening with the debt? Okay. So, as shown in the chart, debt has grown about 7.8% per year since 2000. Gold in that time has actually increased about 9.5% on an annual basis since 2000. So that means gold is increasing about 21% more. Now, right now, the US is adding 1 trillion to the national debt every 100 days. This is a fact. It's well known. We can send you information on this. You can research it. It's adding 1 trillion to the debt. It has to. Just by that alone, in one year, the debt will rise about 11%. That means based on the past 25 years, gold should be up about 13%. Well, where does that put us? That puts us right at the top of the range that I mentioned earlier of 2,700 to 3,100. That puts us right there. Now, will we get there just based on debt? We could. But other stuff could happen. You know, there are geopolitical events, miners running out of supply, futures market speculation. It could have a little bit of a pressure downside of investors, lower demand. There's a lot of factors, but just on debt alone puts us at $3,100. That's 13% within a year. We can absolutely get there, just based on historical means of debt, because the debt means inflation, more money printing, need to pay it off. That's what's going to happen, and it's showing right here. These numbers don't lie. And it's something to keep in mind when thinking about how you're going to hedge your portfolio, protect yourself in this debt, in a coming debt crisis. Now, let's just talk about a little bit of indicators of this debt crisis and market instability. Okay, there's many out there that believe all is going to be okay with this new administration. I understand that. Some don't, some do, but some problems never go away. Okay, they just don't go away. So rising treasury yields is an indicator of market instability, right? Borrowing costs more because the risk is higher, right? To the banks, to the lenders, that happens, right? So this year we just have maturing debt of $7.6 trillion. So what can happen? Loss of investor confidence in bond issuances. So these banks and firms need to buy these bonds, or they buy the bonds secondary. Investment firms like mutual funds, hedge funds, sovereign wealth funds, private investors that buy these bonds lose the confidence, which means the supply is high, demand goes down, brings down the price of the bonds, which raise the yields. And then if the government needs to borrow more, it's going to cost them more, which is inflationary. It's a kind of a little bit of a downward spiral, which just need to be, this is what happens. We need to be mindful of that. So the domino effect is what I was getting at, right? It can come down, and the first to go are equity and property markets. We've seen this in the past, 2008, right? We will see a pullback in that sort of sense. So how do we hedge against these debt crises, right? Well, yes, real assets, gold, silver, agricultural. To be fair, agricultural commodities can really help in these safe havens. Gold is going to be it's going to be the most liquid for buying and selling. Silver, we are big proponents of silver. I have written a lot about silver in the past year. That one is, I think, will be more. It's going to be a protective play, but also a speculative play, because there's a lot of factors that can push silver a lot higher. It is very suppressed. It's not even at its all-time highs of $50, let alone inflation adjusted high of well over $100 from the 80s and into 2011. As I was saying, silver's dual demand, right? So we have that price action I was talking about, but it's also industrial. Lots of industrial, lots of AI. We're going to see a lot of that this year. AI, chips, phones, emerging markets and countries more people getting phones and computers, AI in those. So this is a strong one. I truly believe in. You should definitely be considering that as much as gold. So I want to go back on the silver because I can't stress enough how important this metal is. It's those of you out there might see I've been told that recently there's been more advertisements for silver. They've seen it, on TV and so forth. And by all means, it's the right thing to do because it acts as both a monetary and industrial asset. Right, it's highly liquid, monetary. You have sovereign coins, the silver eagle, silver maple, silver Britannia, but it acts as an industrial. So many people buy it in its raw form for conductors and electronics. So it's more used for that. It has the same aspects as gold, lots of it, being conductive and so forth, but it's a lot cheaper. Gold is about 90 times more money. So you want to put some silver in those things right now. So eventually that disconnect might break and we could see silver really take off. I don't see why we can't see silver well over $50 this year. So, and renewable energies is huge right now. We have solar panels, electric cars, all these renewables, wind power, and so forth from there. So this silver is going to act as a strategic asset in the coming year. So moving on to another part of the subject is the importance of financial literacy. We want to be educative. We want you to understand more than just what metals are, just understanding how protecting your wealth and just reading and watching the news and understanding what it means, right? You need to make important decisions. So I'm trying to help you here to understand what some of these factors are and to look out for this year. So it's very important in using tools, diversifying. At Neptune, we never say put all your money into metals. You want to have a portion. Everybody has a portion. I have a portion. Everybody at Neptune has a portion. It's something you want to diversify and understand how it can help and monitor the market signals, right? Rising yields and inflation trends. Okay, we've talked about those before. You see those signals, you know what they are now. Make sure you understand those and keep watching out for them. Let's talk about what precious metals have done and what will do in these times that are crucial, right? So gold will reserve your purchasing power. So you may see equities come down, real estate, various other forms of investments, but this will preserve your purchasing power in currency debasement. Silver, monetary industrial advantages, just a little bit on what we've been talking about. And I think emerging demand from AI will still hold these metals in a crisis regardless, because the automotive and AI industries need these, and it's something that's the growth is phenomenal. Now, what about post-crisis, right? Because there's rippling effects. The government debt affects currencies, the equity markets, and global economic stability. It will always lead to central bank actions like quantitative easing. We've seen this before. So post-crisis, quantitative easing, they're going to print money, yield control measures, which is, interest rates, and they're going to do this. And this is something that could be very inflationary and devalue the dollar and push up various asset prices, including gold and silver. And then post-crisis, yeah, you may see some opportunity in real estate as when we're talking about these interest rates, because that will affect everybody's mortgage rates and undervalued equities. That's the post crisis. But that right now we're talking about what's to come, what could happen, and how you can protect yourself. So final takeaways on this is you need to hedge against uncertainty. Consider gold, silver, platinum, palladium as well. Gold and silver are the most popular to consider for portfolio diversification. Follow market signals. You got to monitor the rates. We've seen these rates bump up. There is a large concern. Bank activities. What are they doing? What are they buying? Central bank activities with metals and geopolitical events. We've had a couple of things, some good news recently, but there's still lots of stuff happening. There's still wars happening, and I think there's still concern with China in the sea there now, with Korea and so forth from there. Okay, and just leverage gold resistance. Anchor your portfolio during volatility. Okay, it's there. It's been doing that for people for hundreds, many years, but in recent time, it's definitely held its own in a portfolio. So those are my key takeaways from this presentation. I wanted you guys to all understand is to understand where a crisis may come from, why metals did what they did, why they're going to continue to do it in 2025, and how you can protect yourself. And this is all we care about. It's just about hedging and protecting. And hey, if we make a little bit of money on the end, that's good. But you probably just see that you protected your purchasing power, and you may have done a little bit better than your neighbor. So following all this, I just want to talk about what Neptune Global is, if you haven't heard of us before. We're established all the way back in 2002. Our first gold trade was conducted at 289 spot. All right, it's quite a bit different to where it's at now. We are full service precious metals deal. We service individuals, broker dealers, family offices, institutions, registered investment advisor offices. Anything from the small coin collector to the high net worth investor. We have supplied gold, shipped it all over the globe, and we store it at facilities like IDS in Delaware. Where we're a little bit different is we have innovations in physical precious metals investments, which I'll show on the next slide. But we have unparalleled diversification techniques, transparency of all your holdings, and full liquidity. When you need to sell it, it's there. When you need to buy it, we can do it. Okay. Key partnerships that you won't see anywhere else. We have a partner from Fiduciary Trust, which is a division of Franklin Templeton, a $92 billion asset manager custodian. We are a member of the DTCC, the clearinghouse. We have direct relationships with COMEX approved facilities in the commodities exchange that follows rigorous guidelines, and institutional level auditors. So a little bit more about our products, and then we're done. So precious metals acquisition, primarily gold, silver, platinum, palladium. Okay. All types of coins, sovereign coins, eagles and maples, all of them, all the types of bars, up to kilo bars, large bullion bars. And we have some of our own proprietary products. Custodial services, Camaplan, our key partner in the IRA space. They can custodial the metal for you when you're utilizing us as your dealer. We also, on the private side, are custodial services as well. And Fiduciary Trust International is a key partner, especially in the wealth management space. They're a 100-year-old company. We have unique patented products that service all types of investors. Gold Vault, Silver Vault, and the PMC ounce. They are very cost efficient. The PMC ounce provides an excellent risk-adjusted return of getting you into all four metals. Call us. We'll tell you more about how those work. But that's where most of our clients do end up investing, because they understand the value and the savings that they receive, because everything is backed by LBMA approved products, and you see real-time trading and insured depository storage. That being said, next steps, you can talk to one of us at Neptune. You can talk to a specialist. Everybody at Neptune fully understands everything that I've talked about in this presentation. So feel free to give us a call, shoot me a direct email, and in the follow-up in the email, you'll see the contact details. Thank you.
Thanks, Brandon. A lot of great information and things to look out for in the coming months and year. I appreciate the presentation. Our clients have been working with you and Neptune for a very long time, and it's always a pleasure. So if you have time, we can see if we can open up for questions, or if people need time to digest it. Obviously, your contact information is here.
Feel free to contact me directly. That's my direct email. I'm happy to set up a time. call, speak with any of them. And we have several precious metal specialists that are available if they call the main number.
All right. Perfect. Thanks for that, Brandon. I think we'll wrap that up here and give people a chance to reach out. I don't see any questions coming in. Um, does that work for you,
Mhm.
Brandon?
No,
Or
that's good. Yeah.
all right,
Yeah, whatever
perfect.
works.
Thanks everybody for attending. And if you have any questions about um, how this applies to your self-directed IRA, please feel free to reach out to Camaplan. I'm happy to speak with you. And I definitely highly recommend speaking to Brandon and his team over at Neptune about the things he's discussed today. Thanks, everyone.